How will the S&P 500 stock index perform in November 2024? Understanding the S&P 500's behavior during November in U.S. presidential election years is essential for investors and analysts who want to navigate the complexities of these periods. Historically, the index tends to exhibit increased volatility as the election nears, with the most noticeable spikes happening in the 2 months leading up to Election Day. For instance, in the 2016 election, market jitters surged as the race tightened. However, once the uncertainty of the outcome subsides, as seen after the 2020 election, volatility typically cools down fairly quickly, which implies that market fluctuations are heavily tied to the uncertainty around election outcomes. In terms of performance, the S&P 500 has generally done well in election years, showing an average annual return of 12.2% since 1928. In fact, the index has ended the year in positive territory about 83% of the time. Despite these generally positive results, returns during election years are often slightly lower than in non-election years. This was evident in 2008, a year marked by both a presidential election and the financial crisis, where cautious behavior and political uncertainty played significant roles in tempering market gains. The political party that wins the presidency also influences stock market trends. Historically, Democratic presidents have overseen periods of stronger market performance, partly due to favorable economic conditions that happen to align with their time in office. However, regardless of the winning party, the market tends to rally by the end of the year, as seen in both 2012 and 2020, as investors adjust to the political landscape and refocus on economic fundamentals. Beyond politics, the state of the broader economy is a key driver of market performance during election years. Inflationary pressures, Federal Reserve policies, and economic health in general often carry more weight than the election result itself. For example, the 1980 election, which resulted in a change in political leadership, saw market performance driven more by the economic conditions of high inflation and tight monetary policies than by the election outcome. This suggests that while elections create short-term noise, the long-term trajectory of the market is shaped by deeper economic forces. Investor behavior during election years shows a similar pattern. Even with heightened volatility, it's usually advised to stick with long-term strategies. Historically, those who held their investments or continued regular contributions during volatile periods, such as in the 2000 and 2016 elections, performed better than those who attempted to time the market based on political events. Investors who stayed invested throughout these turbulent periods often benefited from the market's natural tendency to rebound once uncertainties were resolved. In summary, while the S&P 500 tends to experience increased volatility and slightly lower returns during U.S. presidential election years, the market's overall direction remains positive. Both political outcomes and broader economic factors play roles in influencing the market, but investors are typically better off focusing on long-term strategies instead of reacting to short-term election-driven fluctuations. Thank you for watching.